So, welcome everyone to the Wisdom Tree Commodity Outlook Update. Our outlook is titled A Strong Setup for Precious Metals. And precious metals have indeed been rallying for the most part of this year. Gold has hit a brand new high as of yesterday. That was the 12th of September 2024. And we expect further new highs to be reached during the course of this year. Looking at commodities and just putting them into perspective in terms of performance over the last decade and looking at this year's performance, well, it's clear that um, commodities have struggled in some years, but in 2021, 2022, commodities were heading towards the top end of the leaderboard in terms of in comparison to other assets. Um, 2023 was a bit of a setback of a year. This is the time at which a lot of the monetary stimulus was being withdrawn from the system, and commodities fell to the bottom of the table there with negative performance. In 2024, although we started off the year relatively well, commodities have once again fallen to the bottom of the table. However, as I'll discuss in our outlook, we believe there's lots of reasons for optimism in the commodity markets, and there's lots of catching up for commodities to do with other cyclical assets like equities. Now, just digging into that 2024 period just a little bit further, uh, here's the same assets indexed to 100 at the beginning of this year, and you can see here the yellow line commodities had been performing in line with equities up until around the middle of this year, till June. However, after June, the summer was just not kind to commodities. Commodities fell in the latter half of June, July, and in August, all assets went through a very volatile period at the beginning of August. Uh, Other assets actually recovered from that a little bit more vigorously. We saw a very strong bounce up in equities after that initial wobble at the beginning of August. We saw real estate really take a strong leap forward. In fact, up until the beginning of August, real estate was underwater. And then it really accelerated after that. And, even sovereign bonds are rallying right now, therefore having outpaced commodities. And at the beginning of September, we had another wobble in most asset markets, commodities included, and commodities hurt at that point. But however, in the last few days, we have been seeing a very strong rally in commodities, and that commodity catch up that we had been expecting is looking like it's coming to the fore. So we've seen a broad-based rally in commodities across metals, oil, precious metals. As I mentioned, gold has hit a brand new all-time high once again. Now, for precious metals, generally they've been doing well already this year. This is a similar sort of quilt ranking, not across assets, but within the asset, looking at commodities and looking at the subcomponents of the commodity basket. You can see here the final column, 2024 year to date. So that's the end of August. We've had precious metals, so that includes gold and silver. That's rallied close to 22%. Industrial metals have also done well, 6.7%. Really, what's dragging the commodity complex has been agriculture and energy prices. So there is a bit more of a concentrated area that's acting as the the driver of the weaker performance in the commodity markets relative to other assets. But we should note that that precious metals are, especially when you look at gold, a bit more of the defensive type of commodities. They act as a good hedge against geopolitical and financial market shocks. Whereas most of the rest of the commodity complex is a little bit more what you call cyclical, and they tend to rise a lot more with increasing economic prosperity. So let's turn to that and dig into that area which has performed the best so far, gold. And um, we at Wisdom Tree have developed a model for uh, explaining gold prices. And in summary, the model basically has four major aspects that drive gold prices. The first is inflation. As inflation rises, gold prices tend to rise. Um, the dollar basket, so as dollar appreciates, that tends to be negative for gold prices. Bond yields, as bond yields increase, as in bond prices fall, gold prices also fall as well. And they're both competing anti-fragile defensive type of assets. You'd expect their price movement to move in the same direction and therefore have an inverse gold price as an inverse relationship to yield. And the last major driver of gold prices is net speculative positioning in gold futures, and we use that as a measurement of sentiment towards gold. Now, what you'll notice here is that gold doesn't look like a regular commodity. Most commodities you'd expect supply and demand to be the main drivers of price. Gold isn't like that. Gold is much more like a pseudo currency. It's all these big macro drivers that seems to move its price: inflation, dollar, yields on bonds. So what our model does is takes those four things, and the actual gold prices are shown on this chart is that greenish line. The What comes out of our model, and the model explains a good 65% of the price movements, is shown in that gray line. The bars are basically the components of the model. So the sum of all the bars should come up to the gray line, what comes out the model. The advantage of disaggregating and adding those bars into this chart is we can see what's been driving gold at any point in time. So if we look at this chart, we can see that since, let's take from the beginning of 2021, it's been high inflation that's been driving gold prices higher. Sentiment to gold towards gold has been very strong in 21, beginning half of 2022, and then once again back in the second half of 2023, going into 2024, sentiment has been very strong. What has been a drag against gold prices for most of that time period has been rising bond yields and dollar appreciation. For most of that time, it's been a drag. But the high inflation and the strong sentiment towards gold has been the thing that's been driving gold higher. But if you look at the very, very last bar of this chart, that's the August bar, you can see we've turned a corner. Both the dollar depreciation and falling bond yields have started to add an extra tailwind to gold prices. And we believe this is the item that's really driven gold prices to that new high in the last few days, as Federal Reserve interest rate cuts are only a few weeks away, and that is driving bond yields significantly lower and also depreciating the dollar relative to the euro, yen, and other currencies. So gold is set up for something great because these interest rate cuts are forthcoming. We're likely to see more dollar depreciation and treasury yield declines, even if inflation moderates and even if speculative position, which is elevated today, remains quite flat or even declines from these levels. Um, there are a couple of other things that are driving gold, and maybe just going back to that previous slide. One thing that you should note is that the actual gold price increase has been a little bit higher than our model. and that I can explain maybe through some other things that haven't come up statistically significant in our model framework when we test them, but maybe having some increasing importance today. So one of the things is the flows of gold into exchange traded products. They have now started to pick up a little bit. Now, we'd gone through almost 2 years or actually more than 2 years of um, outflows from exchange traded products, gold exchange traded products, and that's unusual because normally when the flows into exchange traded products, gold exchange traded products, had tended to go up with increasing prices, but that really broke down in 2022, and we saw 2 consecutive years of outflows even though prices were rising. But come June of 2024, we've turned a corner. We're starting to see inflows, and that could be adding that next sort of tailwind into gold prices. And it's not just the ETPs that are increasing in their sentiment. The net spec positioning, as I mentioned earlier on, that is our main measurement for gold sentiment, and that's running at around 300,000 contracts net long, which is quite strong given the historic average is just below 200,000 contracts net long. And what's driving a lot of this is, as I mentioned, geopolitical tensions around the world. The Israel-Hamas war, the war ongoing on in Russia-Ukraine. On top of that, we've had a really busy election schedule during the course of this year, and obviously a very big election is coming at the end of this year. Well, in a couple of months' time, and that's the U.S. presidential election, and there's lots of cause for people to be either happy or worried, and people express some of their worries through holding defensive assets like gold. Another big thing is the demand for gold from central banks, and that's been extremely strong. And you can see here from this chart in 2022, we went just to another level. And that was really driven by the Russia Ukraine war. The result of that war was that G7 central banks froze the assets of Russia's central bank in their currencies, and that spooked every single central bank out there. Most central banks are fearful of falling on the wrong side of the G7 from a geopolitical standpoint and wonder what would happen to their assets. And therefore, they're diversifying their FX reserves away from the dollar, yen, euro, pound sterling towards gold, because that is the one pseudo currency that no other central bank can control. And therefore, they're loading up on gold. So 2022 was a record high. 2023 only marginally below that. The first half of 2024 has been a record high for first half demand. Second half of this year may cool a little bit relative to the first half because China hasn't been buying that much over the last few months. But nevertheless, we're in a new sort of paradigm. That level that we've been seeing in 2022, 2023 is much more like the sort of levels we're going to see going forward. And if you look at the surveys of central banks, their intention is to keep buying and buying large. So no central bank out there surveyed expects central banks to be decreasing their holdings in 2024. And a lot more of them are expecting increases rather than being unchanged. So that's a lot on gold, but following closely on gold's coattails is silver. And silver actually has, if you look in percentage terms, is actually outperformed gold since the beginning of this year. So percentage-wise, it's doing better. It's not hit a new higher all-time high or anything like that, but percentage-wise, year to date, it's done better. And but it's still in relative terms. If you look at the gold to silver ratio, gold prices divided by silver, that looks elevated, looking like gold is getting the upper hand. However, we are quite optimistic that silver would continue to make a catch up. If you look at the gold to silver ratio, we're almost one standard deviation above historic norms. The historic average is the yellow line. That bluish line, the darker, slightly bluish line, is the one standard deviation mark, and we're above that right now. We believe that silver will make a bit more of a forceful catch up, and we're even more optimistic on silver. Silver has a roughly 80% correlation with gold prices. Why are we so optimistic about silver? Well, silver is uh, increasing its demand for silver is increasing in industrial applications. About 50% of silver goes into industrial applications to start off with, and an increasing proportion of that is going into photovoltaics, so that's solar panels. And we're seeing a boom in solar panel demand, but also the amount of silver going into each solar panel is also increasing. So photovoltaic demand for silver has doubled between 2021 and 2023. Just in a short space of time, doubled. And it's not just photovoltaics, but silver demand from new technologies like 5G technologies, automotive technologies, all the electrical contact points in a car, especially electrified cars. Also, the artificial intelligence revolution requires a lot more electrical components and a lot more, demand on a kind of electrical grid system, which would also require a little bit more silver. Um, but speaking on that point on solar technology, the most efficient newer types of technologies in solar panels have higher silver loadings. If you will go back to the last decade, although we saw rapid growth in solar panel installations, each installation was using less and less silver because they were getting, they found technological routes to reduce silver. But the latest technologies, the TOPCon and HJT types of solar panels, will use more silver per application. And therefore, and if you look at the right hand side chart here, projections for TOPCon and HGT are dominating the installations for this year, and for that reason, silver in each application will go up considerably more. So silver demand is very strong, and silver is already in a supply deficit when you include investment demand. Even if you strip out investment demand, the surplus is so wafer thin, and it could tip into a deficit even without investment included, and that would be sort of record tightness for silver. And the data goes back, roughly 20 years. Another set of precious metals, platinum and palladium together, platinum group metals, they are both in supply deficits as well. And there have been for palladium for the last few years, last 3 years, platinum for the last 2 years, and for 2024 we expect the palladium deficit to even widen. Platinum will remain in quite a deep deficit still. Now, where are these metals used? Mainly in cars. They are the things that are used in what they call the autocatalysts. They turn the nasty gases coming out the exhaust into safer gases. And they're utilized mainly in internal combustion engine vehicles and hybrid vehicles, right? So there had been a lot of fears by the market that the internal combustion engine vehicles will lose market share rapidly against electric vehicles, and therefore the prices of these two metals had suffered over the last 2 years. So platinum, palladium aren't doing anywhere near as good as gold and silver, but there is catch-up potential, we believe, and we are actually starting to see the hybrid car actually gain a little bit more market share, and enthusiasm behind hybrid cars are still increasing at this point, and that could be an upside surprise to demand for platinum, palladium. At the same time, supply for these two metals, Russia and South Africa, the main producers, for these metals is looking a bit constrained. If you look at investor positioning in these metals, it's looking quite slim. So this is the net speculative positioning in both palladium on the left hand side and platinum on the right hand side. And you can see here is looking at the lowest, at least in the last 5 years, for palladium. If you just look at the short side of the equation, so not the net of the long and short, but just the shorts, we are almost at record highs for bearishness for palladium, and also on platinum was close to standard deviation below normal, which is reflecting a lot of bearishness there. We think that bearishness is unwarranted at this point because it's overdone, and this market is ripe for a short covering rally. A couple of days ago, President Putin announced that there will be curbing nickel exports from Russia. And most of the palladium that's produced in Russia comes as a byproduct of nickel production. So if they end up restricting the nickel exports, and if they end up producing less nickel because of that export restriction, that could also have a knock-on impact on palladium and reduce the palladium exports as well from the country. So that is a sort of present risk at the moment, and I believe that could be something that could generate a rewind of this really deep shorts, i.e., a short covering rally. So, turning more to broader commodities outside of precious metals, and what we believe is the clear thing for commodities is that commodities do well in a lower interest rate environment. And hopefully that's proven here in this scatter plot. The real rates are on the bottom axis, so that's 2-year treasury yields less inflation. And on the vertical axis, we've got real commodity prices, so that's commodity prices less inflation, and I'm using US inflation over here. You can see a nice sort of line of best fit. That dark line over there is the line of best fit through most of the data points. Yes, there've been exceptions in the past. The very light blue dots or teal dots are during the oil crisis of the early 80s. That flipped the equation on the head. But even during the COVID crisis, those that kind of medium blue dots over here shows that the negative relationship was maintained even during the COVID crisis, maybe just at a lower level of general price movement. But that slope of that line was about the same. So the lower rates go, the more positive it is for commodity markets. And most of the world, most of the developed world at least, is cutting interest rates right now. And we expect the Fed to be cutting rates within a few weeks. So there's a nice boost for commodities. And I think that over the last few days, as I mentioned, we've got this nice commodity rally that seems to be in play. And I think is really being set up by this lower rate environment that we're heading into. Now, and so obviously the correction on some of the excess bearishness that I mentioned as well. Now, one of the reasons for potential caution is that commodities are highly geared to global trade. As export volumes around the world decline, that tends to have a negative impact on commodities. And we already started to see that, right? As export volumes have been falling in the last year or so, that's already had a knock-on impact on commodities. We believe that one of the big dangers right now is this trend of nearshoring, friendshoring, retraction, and mainly, the target is often China out there, moving away from trading with China because of China's dominance in certain areas, and trying to bring that more to domestic markets. And we've seen that in the U.S. presidential elections, because both Harris and Trump are promoting a platform of being more trade hawks, reducing trade with the rest of the world, China in particular. I think the Trump Vance team are probably the more trade hawkish, and we know from Trump's presidency last time that trade tariff war that was set up was clearly negative. We saw that back in 2018, and you know that could potentially hurt the commodity markets. Now, what I would say is that whoever is elected as a president, they're both got hawkish narrative at the moment, but the earliest or they can be inaugurated is January. After January, they would have to press hard for any new policies to be put in. And even if they use the so-called Section 301 policies that Trump used during his era and fast track those, we're still talking several months before any new trade policies are put in place. By which time we would have had lots and lots of interest rate cuts. So the rate cutting environment is going to provide a nice window for commodity prices to rally even before any new trade policies come in, if they come in. All right, it's not even a guaranteed that their new trade policy would be pushed forward. One of the things I'd like to highlight in for commodities is something that's been weighing on metal prices, base metal prices in particular. And that's, you can see over here, is the inventory for many base metals have been rising, both on the London Metal Exchange and on the Shanghai Futures Exchange. Markets use this as a big signal because that is one of their visibility into supply demand balances, and you may not get high frequency data on supply and demand, but you do get high frequency data on what's held on exchange, and it's just a proxy. It doesn't tell you what's all inventory, but as a proxy it seems to indicate that there's more material out there. Now, unfortunately, it's only giving you a partial view of the world, and then unfortunately prices were reacted to this more than they should have. And let me explain. We have China out there spending much more than ever on its electrical grid system. The way to read this chart is, the bottom axis is the months of the year. The lines we're talking about the cumulative grid spending. We look at cumulative because China's calendar doesn't align well with the Western calendar, especially January and February. We need to combine all together anyway, and the start of this new year doesn't align, and you get some seasonal issues as a result. So looking at the cumulative numbers is the best way. The cumulative line for 2023 is the blue line. The range we've seen between 2010 and 2023 is that sort of lighter blue shaded area. 2024 year to date is basically the black line, and we can see here that we're above the previous range, so we're at record highs for spending here. Now, what does grid spending mean? Grid spending means buying copper and aluminium and putting transmission and distribution cabling out there. So the money is being spent on these highly metal intensive industry. It just hasn't hit the road yet. It hasn't been purchased yet. And therefore, the inventory is looking quite high at the moment. If you look at another way of looking at things is the treatment costs for copper. So when a refiner takes the material, they pay the the producer a treatment cost. Now, when the ore is very, very scarce, that treatment cost falls, and we've seen the treatment cost fall to an all-time low. It's close to zero. The refiners basically are charging almost zero for refining this material because the material is so scarce. So they're producing a lot because there is a need for it going into grid expenditure, but it just hasn't been consumed at this point in time. So there's a time lag here. So we believe that base metal prices will correct at some point and head to the upside. And we'll probably start seeing a bit of that already in the last couple of days. Turning to another area of the commodity markets, and that's the oil market, a very big part of the commodity market. And what we see here is oil has largely been range trading for most of this year in 2024. In that sort of range of 70 to 85 for the most part, 70 to 85 dollars per barrel. That is, and you can see that here in the black line, where what we've done is index that to 100 at the beginning of the time series, and you can see the black line has been in 2024 kind of hovering around that 100 marker, not deviating much from that. But when it comes to investing in oil markets, that is achieved through futures markets, right? So even when investing in an exchange traded product in oil, it's tracking futures, and futures have several components of their return. It's not just the spot market price that matters. There's also the interest rate that you're owed for a fully funded investment in the future, but also you get what is called a roll return, and that roll return is basically generated by the shape of the futures curve. Now, in many commodity futures, you'll see an upward sloping futures curve where the price for something for delivery in a few months' time costs more than the price for delivery immediately. And that reflects the storage costs and maybe insurance costs and stuff of the commodity. In the oil markets right now, we're in the opposite. The curve is in backwardation. We have a downward sloping curve. The price for delivery immediately is higher than the price for delivery in a few months' time, and that reflects scarcity. There's less of the oil around and people are willing to pay more for immediate delivery than wait. Now, why is there that scarcity? And the scarcity is largely generated by the OPEC cartel, so the Organization of Petroleum Exporting Countries. With them and their partner countries, they control close to 45% of global oil exports, oil production, sorry. And for the last couple of years, they've been holding close to 3 million barrels per day off the market. In the market is roughly 100 million barrel per day market, so roughly 3%. That has had a meaningful impact in tightening the front end of the supply, and that backwardation is helpful in generating a return, because in backwardation markets, as the future price approaches spot through the passage of time, the price of the contract increases, assuming the curve doesn't change. So that backwardation in oil markets is generating close to an 8% annual yield, which is really, really strong. So when investing in exchange traded products, for example, in Wisdom Tree, Brent, or Wisdom Tree, crude, which is tracking the WTI index, you are getting that roll yield incorporated. So even in a flat moving spot market, you're getting something very positive because of roll yield. Um, Turning to one other corner of the commodity markets, that is obviously, as I showed at the beginning, is a place where we saw some drag on performance, but there have been some big winners in the agricultural market, including coffee and cocoa, where in the past year, in the case of cocoa, prices have increased almost fivefold. So that's 600% increases on prices there, stellar returns, and that's partly due to this extreme weather issues that we're seeing. In the case of cocoa, about 70% of the world's cocoa is grown in one part of the world, in Africa. And when you have a weather disruption, it affects the crop big time. And we are seeing massive climate change related issues in the agricultural markets. If you look at ocean temperatures, the range from 1981 to 2010 is far below what we've been seeing in the last few years. 2023 hitting new highs, 2024 even above that. So the last couple of months we may have got back to 2023 territory, but it is extremely strong. We're hitting new highs, and that's having massive climatic impacts, driving certain agricultural commodities a lot higher. And if you look at some of the sort of the academic literature out there, they've shown that the heat waves that we're seeing are lasting longer, they're spiking higher, and therefore likely cause a lot more damage to crops. And obviously, that will have an impact on yield and therefore a positive impact generally on price. And we believe the best way to hedge against the impacts of climate on the food supply chain and the food price inflation is to be invested in agricultural commodities. So a basket like Wisdom Tree Agricultural Commodities (AIGA) would be a very good place to provide some hedging against this risk. I also, I just conscious that I've mentioned some products here. Let me just throw some out for some of the other things that we've talked about earlier. So, talking about gold, if the slide moves, we have Wisdom Tree Core Gold, WGLD, which is a physically backed gold product. And it's one of the lowest priced in the market out there. The advantage of having physically backed material, which you can easily achieve in precious metals, is that you don't have to deal with any roll yield issues. And when we talked about oil, roll yield is nice in oil because it's in backwardation, but most precious metals, if you look at the futures market, they're in small contango. You don't need to deal with that when you're in a physically backed. In a physically backed world, you remove any issues of contango, and you get the maximum return from the underlying. And obviously, the pricing points for the physically backed are even better as well in terms of the management fees as well. In a similar vein, we have a precious metal, a silver physically backed product as well. Wisdom Tree Core Silver as well. Priced at 19 basis points, is one of the most attractive out there in the market. That's a relatively new product that we launched just a few weeks ago, and we brought the pricing lower, and also there's lots of other features. Being a newer product that we've been able to replicate off Wisdom Tree Core Gold. When it comes to platinum and palladium, we also have Wisdom Tree Platinum and Palladium, each individually as metals. We also have baskets of these metals as well, so physically backed basket of all four of those metals in fixed weights in terms of the metal weight or the metal entitlement. So there are some options there. And in terms of if you're interested in looking at a broad range of commodities, we have several options there. Wisdom Tree uh, uh, Wisdom Tree optimized solutions, which look at the sort of curve structure and position on different parts of the curve to reduce roll drag for those. But also, if you just want to look at front month following positions, we have PCOM, which is a looking very much at the same sort of benchmark as the Bloomberg Commodity Index. Apart from those precious metals, gold and silver, once again, we physically back those to be able to reduce that roll drag a little bit there and provide the best returns from that standpoint. And then when you would look at metals, we've got a huge range of metals. I don't think I've got the time in this thing to mention every single metal that we have. But we have baskets of those metals as well. Some that are geared towards the energy transition. So if you believe in this sort of China electrification story and the electrification of the rest of the world as well, we have some baskets of products that also draw on that as well. So I hope that has given a good insight into what is driving commodity markets right now. Just as a very quick summary, precious metals are already leading the way, and we expect them to continue to be the best performing as they lean into the rate cuts, but also are hedges towards some of the risks, geopolitical and financial. Rate cuts are great for all the commodity complex, and we expect commodities to really start making a catch up with other asset classes as a result. And some of that we already started to see in the last few days. Yes, we understand that there is some reason for caution around trade, but we believe the rate cuts coming in earlier will be a big counterbalance towards that. When you're looking at climate change and the effect on food prices, agriculture is probably one of the best ways of hedging against that risk. China is doubling down on, or possibly even tripling down on its energy transition strategy, will consume a lot more metals as a result, counterbalancing some of the declines that we're seeing from real estate demand for metals in the country. And we expect that to be more and more recognized in prices. And we expect that, the upward correction in prices as a result. And also in the oil markets, once again, as long as OPEC hold the strategy and keep the curve in backwardation, oil is a great place to be because of positive roll yields there. And our expectations are that that OPEC will continue with some sort of strategy like they have. Last week, they announced an extension of their production restraint for another couple of months. We expect the hand to be forced to keep extending that going forward, and we believe the backwardation is there to remain. So, really appreciate you listening in to our outlook over here. We at Wisdom Tree are always open to hearing back from you. If you do have any questions, please do send us the questions, whether they're on our outlook or on our product range. I'll go back one slide over here. You can see the email address written over here and our phone number if you want to ever get in contact with us. And once again, want to thank you so much for listening into our outlook.